Thank you, Thomas, and thank you to the organisers for the opportunity to talk about the dry bulk freight market again at the conference. It's a market that's getting ever more complex, and the very sad events this year in Ukraine have added another layer of complexity to the shipping market outlooks to go along with the ongoing effects of the COVID pandemic and the import ban in China on Australian coal, and also the decarbonisation agenda, which is coming up. So my job today is to simplify what this means for charterers of ships, what this means for the steel sector in general, and also provide some insight as to what may happen next. So taking this in turn, I'll start off with the current market situation, where we are currently, looking at Ukraine in particular and the consequences for freight, the positives, the negatives, and then looking at fleet developments and how decarbonisation will be affecting those supply-demand balances in the next few years. Taking this chart first of all, this is Capesize spot iron ore and coal voyage rates into Asia. These are numbers compiled by SSY, as our company is shipbroker. As you can see there, we've had extreme volatility in the last 12 months. In particular, you can see the Capesize costs to move 1 ton of iron ore from Brazil to China soaring and reaching nearly $50 per ton. So quite clearly, freight once again having an impact on the cost of raw materials. This chart also shows that it is very volatile. And you can see there that it pulled back in the same rate to below $20 per ton. And as I speak, just in current time, we're around $25 per ton. So that volatility is there as well at heightened levels and having a real impact on the delivered cost of coking coal and iron ore. Taking the Capesize market, first of all, of course, there are more elements to this, and I'm going to focus more on the smaller sizes after this, but just taking the 180,000 deadweight vessel, first of all, you can see here in the January to December basis that the Capesizes are, even though we're at relatively high levels, supported also by increased fuel costs in voyage rate terms, we are actually underperforming levels that we've seen in recent years. So that immense peak that we saw in October, and that's just looking at this dollar per day rate, we are actually at a fraction of that level. Now, the early starts of the year, the first few months of the year, tend to be lower for Capes, and that generally relates to lower iron ore export availability from Australia and Brazil due to weather-related reasons, sometimes maintenance and so on, and more recently in Australia due to COVID restrictions affecting the workforce in Australia. So we're seeing a combination of factors, but what's interesting about this market in general is the fact that the strongest performers are the smaller sizes. And this chart here, we're looking at the handysize, this vessel here of 38,000 deadweight tons, much smaller in terms of capacity than Capes, but actually performing better for most of the last 12 months. And this chart here on a January to December basis shows that we had a significant outperformance from last year. And last year was some of the highest levels that we'd seen since the boom market of 2008. So once again, the market is pushing onwards. And what's remarkable about this is that this is all happening against the background of war in Europe and in terms of Ukraine seaports, a complete shutdown of Ukraine seaports. And this is affecting a grain trade of 50 million tons per annum, as well as the iron ore movements there, which we would estimate at over 40 million tons per annum. This loss to the market is there. Ships were sent free from the Black Sea back into the market, but still the underlying move was upwards afterwards. So quite a remarkable turn of developments for the shipping market, and we'll look into what this actually means. One of the key strengths behind this is that we're seeing more firmness and more support for vessels in the Pacific. This chart here shows the Supramax market. In black is the sector average, the 10 time charter rates. In red, we can see the round voyage from Indonesia to southern China. And this chart shows that normally the Pacific market underperforms the overall sector. This tends to happen because you have more loading in the Atlantic and more discharging in the Pacific. But that balance turned around in 2021, and part of the reason for that was a shift in trade dynamics. We had more exports of Chinese steel and fertilizers dragging vessels out of the Pacific. Australian grain exports had a bumper season. We also had the strength in demand, but underpinning that really was a lot of fleet inefficiency and delays of going into ports in China. Some parts of China, sometimes of last year, we're looking at 14 days quarantining. Also very strict going into Australia as well. So extra days at sea really did affect the shipping market, and particular for smaller vessels that are more likely to do short haul voyages from the Philippines or Indonesia into China, for example. The effect of COVID seems to have hit these more. One other thing I should say about the smaller sizes is that they have and continue to benefit from a soaring container ship market. So additional cargoes finding their ways onto bulkers, either in containers or out of containers, but also that's using up the bulker market very, very inefficiently indeed, so providing support. So what we do have this time round, as well as having an exceptionally high market, is that we have a market driven by smaller sizes and also with most of its strength in the Pacific. So the negative risks then for the freight markets, first of all, we'd say it's that loss of cargo from the Ukraine. Now, there are railing grain and iron ore into neighbouring countries in the EU for further for onward shipment, but of course these will be at far lower volumes than they would have normally had seaborne wise. We were looking at Russia, of course. We do anticipate as well a dent put in for Russia's coal imports, not just because of upcoming import bans into the EU, the UK and Japan, but also because of some over-compliance, that reluctance to get involved in the trade for fear of becoming entangled or not wishing to be seen in the market to be linked too closely with Russian coal. So some ship owners have been taking the step of not being involved in those trades whatsoever. But as things stand at the moment, we will anticipate some redirection of Russian coal away, but the real key challenge, of course, for European, say, Japanese buyers of coal is where to source the additional coal from. And that brings us on to another negative, is that where are the immediate alternative sources? They are quite limited. We also note that with the rising inflation and the pressures that this puts on the market, that there could be some erosion of demand within the world. We also note that it could be increased production costs there for fertilizers and therefore onto the grain markets for next year, as well as those rising production costs for steelmakers. It could also be that with international coal prices soaring as a result of these measures, that India and China use more domestic coal at the expense of the seaborne market. And finally, if the COVID-related delays in China, which are currently at the moment getting very severe, if they were to ease, then that would free up a lot of vessels to trade more normally and bring more capacity back into the market. All of these by themselves are very significant negative pressures. But of course, as we can see in the first charts, the freight market is actually moving up at the moment. So where is the support from the sentiment, the very strong sentiment in the freight market coming from? Well, firstly, there is an understanding and of course an awareness that yes, there are scant really alternatives at the moment. They are few and far between, but this could well ultimately involve some longer haul voyages. In particular from grains, and get some more grain from the east coast of South America into the markets of the Mediterranean and Middle East that were served by Ukraine. That, of course, is beneficial for shipping demand. And also, as we also mentioned, South America, also the case for US, where there's more corn being sold as well. For coal, yeah, you could see more upside from Colombia. The more capacity can come in from Colombia into Europe, for example. There could be, and this is really grades permitting because a lot of this material is sold out, some PCI that could be moved potentially from Australia into Europe. I think the market's looking very carefully at this. If that were to happen, then you've got some quite serious backhaul from Australia into Europe, which would of course be very beneficial for shipping demand. But of course, there's a certain amount of uncertainty attached to this, and we wait and see how things develop through the year. For Cape sizes, iron ore cargo availability is set to improve in the second half of 2022. And with what we're seeing in China, this will keep those container dislocations that have been crucial in supporting that market. It will keep them in the system and therefore keep the shortage of containers ongoing into beyond the short term. So this again is very beneficial for ships, especially those smaller ones. And the final point is that the new building delivery schedule is very much reduced, especially given this stage of the freight market cycle. At this stage, we've seen some of the highest rates, as we're talking about, since 2008. Normally, this would encourage a lot of ordering from ship owners, but the levels that we're seeing at the moment are, by historical standards, very low. And one of the main reasons for this is that we're looking at a decarbonisation measures entering the shipping market. Ultimately, if you're looking at ordering a ship, long-term investment of 15 to 20 years, you do of course don't want to be at a competitive disadvantage if new legislation comes in and you're looking at the move to burning alternative zero carbon fuels of the future. Now, there is uncertainty as to what design works best at the moment. LNG as an alternative is of course extremely expensive as a fuel at the moment, and also the unit costs for ordering are quite high. So what we have is a real slowdown in deliveries in fleet supply as well, and that's also underpinning the market. So for charterers in the steel sector are going to increasingly face quite optimistic ship owners that are aware of all these various factors and are certainly getting more positive about the future. Just to give you an idea of the volumes that are missing from Ukraine, we've got here Russia and Ukraine together. We understand that Russian grain exports are carrying on from the Black Sea, as well as all the different areas that they do, some from the Pacific as well. For the area that really is going to be most sharply reduced, of course, is Ukrainian grain. As I mentioned, this totals about 50 million tons, and about half of that is actually long haul in its destinations anyway, going into markets in South and Southeast Asia, particularly Ukrainian wheat, which tends to start in around July of the calendar year. So that is certainly a loss to the market. In terms of Russian coal export destinations last year, we've also highlighted the fact there that Europe, in terms of our seaborne estimates, we're talking about in the region of 40 million tons moved by sea last year from Russia into Europe as a whole. In contrast, you can see there that China is already a very important market. India less so, but both of these two importers, China and India, have immense power in the market. We're looking here mainly at steam coal, mainly at thermal coal question here, but we would expect that move towards China and India from Russia will now accelerate as a result, and as soon as payment alternatives can be found in those currencies. So then looking at decarbonisation, I'm trying to put as many factors into this as possible because shipping is facing one of those extraordinary years at the moment. We have decarbonisation targets set to apply already for new buildings. They have to comply with increasingly standards on decarbonisation, on becoming more efficient as vessels. This is going to be from January 2023 expanded to all ships in the fleet. So from the first survey after January 2023, all ships will have to have a EEXI certificate, which means that they are going to be seaworthy and able to comply. Now, this standard itself may, for some of the very non-compliant vessels, create some problems. There could potentially be some additional scrapping of the very, very non-compliant vessels. But given the strength of the shipping market at the moment, probably the case that more what we're going to see is a lot of derating of engines, so to enforce lower engine speeds and therefore comply with the new legislation. So this will end up with some of the less efficient vessels, they're having what's an engine power limitation. In effect, that means that they're going to be reducing the average speed over the longer term. And this will, of course, be something else that reduces fleet capacity from 2023. So arguably, you could have less disruption from COVID, but on the other hand, you could have more in the way of fleet inefficiency from decarbonisation measures. Shipping will also be included in the EU emissions trading system for 2023. So it could have the effect that for the Pacific markets, for example, that they will have some of the less efficient vessels trading in the Pacific, and with more efficient vessels trading in the EU. There may well be additional marketplace-based measures coming in. In other words, levies on bunker fuels or levies on carbon emissions. We put a question mark because these are proposals at this stage. I've mentioned slow steaming and scrapping already, as well as the uncertainty over new building designs. And for the next few years, it's not really so much about changing fuel type at the moment, it's about just increasing efficiency. But beyond 2030, when you're looking at the IMO's as the shipping authorities' next targets, then it could well be that you have to move towards a more zero carbon fuel, such as biomethanol or green ammonia, bio-LNG, or some other accommodation in order to become compliant with new regulations. What this does mean in the short term, here and now, is the order book, and what we've got on this chart here in blue. This is the entire order book for dry bulk carriers. It is irrespective of year of delivery. This is the total order book as it stands at the end of each year. As you can see there on the far right-hand side of the chart, you have a relatively small order book, considering that the market is at its highest level since 2008. In red, you can see the order book as a share of the existing fleet as a percentage, and so we're around 7%. Now, going back 10 years, we're almost 70% in that same measure. So you can see there that there's not that many more vessels to come in, and this is what's also encouraging a lot of confidence among ship owners. Our forecast is for fleet is shown on this chart here. As you can see, we've got the new building deliveries in blue. We've got our anticipated deletions, in other words, largely scrapping, in red, and in that those numbers refer to the net fleet expansion in each year. So that's 23 million deadweight we expect this year, compared to 30 last year and 35 in 2020. So fleet supply growth slowing down at the same time, and those fleet inefficiency measures are squeezing supply even more. So these are the reasons then that it is possible to have a higher freight market at a time when trade growth really overall, to our view, is slowing right down and really getting pretty much close to zero trade growth currently. So this chart here shows our overall picture. This is SSY's trade growth picture involving all the commodities that are shipped in bulkers in grey, and that's on the left-hand axis in tons. If we look at the right-hand axis in blue, you can see there the IMF's GDP growth forecast, with the latest one of 3.6% growth added in there. So that is actually, in my own personal view, slightly surprisingly high figure chosen by the IMF. But in terms of trade, we're really struggling to see where a lot of the trade growth can come from. Of course, there is immense risk attached to any of these outlooks. And as a lot of forecasters say across all commodities, that this really, a lot of these are tentative because of the vast uncertainties involved making this market picture. But for SSY's view, that's our trade and fleet supply forecasts. So in conclusion then, the freight market fundamentals have been reshaped and forced a rethink on supply-demand fundamentals in 2022 as a result of the invasion of Ukraine. There is still some long-haul trade potential. Looking there at coal and grain, but it has been discussed about some people in the freight market looking at steels to see if there are any unusual trades that could emerge there and alternatives that can also support shipping demand. The container market strength has been a big factor for the smallest bulker sizes, and that really is supporting market sentiment. On the other hand, we do read quite a lot of negatives for shipping markets, such as cargo loss as a result of events this year, inflationary pressures in all its various forms, political instability. These could be major downside pressures on vessel demand. But really, for the moment, it seems that this relatively buoyant picture, at least for the next few months, is being supported by the fleet inefficiencies. And I'd say at the moment, really highlighting what's happening in China. Now, this doesn't just impact vessels that are looking to discharge cargo or pick up cargo from China that are being taken out of the market, but also vessels that had dry docking scheduled, because around Shanghai there are so many yards that are involved in maintenance. There are also so many yards there that are involved in shipbuilding. So what happens there in Shanghai really slows down also just normal operations, dry docking, as well as trade. It also impacts the pace at which new buildings can arrive onto the market. So certainly one of the crucial factors in explaining the current market strength and why really a lot of the forward curves not showing too much of a slowdown until at the earliest, the Q4 of this year, is why this is the taking effect. So thank you very, very much for your attention. And I very much appreciate that. Thank you.